Welcome to today's episode of the Simply Financial Podcast. I'm your host, Christopher Calandra, and I would like to increase your financial IQ with today's episode, where I talked about what I and the team here at Elliott Wealth Management, that we consider it to be a central issue, that being inflation, Fed policy, and interest rates. And so my friend and associate here at Elliott Wealth Management, Brett DiPasquale, and I wanted to invite him on. Some background: Brett DiPasquale is a veteran financial advisor, having been around the industry some 15 years. Second generation. His father had a successful career in financial services also. And for those of you that are clients of Elliott Wealth Management, you know that we went through this merger on January 1st. Giving my team and I access to more help, greater resources, and Brett largely represents that day-to-day help. It's been a joy working with him. He's a great guy, super smart. He's been on the show before, but we're going to talk a little bit about inflation, Fed policy, and interest rates today. Brett, thanks for joining me.
Thanks for having me.
So you listened to the episode that I had done outlining my thoughts. What are your thoughts on current Federal Reserve policy? I think there's a lot of overlap between you and I, but probably not identical. What are your thoughts?
I think over the past year, the Fed's been giving different indicators that they really haven't followed through on, if you can take a look at it that way. About a year or so ago, going into 2024, into end of 2023, there was general consensus that in 2024 there was going to be a lot of rate decreases, or even the probability of that happening was very high. And we can see now in May of 2024, it's looking like a higher for longer type atmosphere. So we might not see any of those decreases that were originally talked about. So to answer your question, I'd say Fed policy right now is a little confusing.
That's interesting. So when I gave my summary on the last episode, I talked about expectations changed. I talked about how in the latter part of 2023, expectation was for rate cuts starting maybe as early as March, maybe as many as 5. And then I simply addressed the issue as expectations have now changed because inflation stopped going down, has remained stubborn, even ticked up a bit. But it sounds like your view on that is not just that expectations changed, but the Fed has been confusing and maybe don't have a great handle on the situation. Is that how you would characterize it?
Yeah, I think that's fair. I think that they're also so concentrated on what the inflation numbers are, they don't see how it's really affecting the economy. So most of the market is moving based off of what the Fed's been saying.
Yeah.
So everybody's paying big attention to their feelings on it, which continue to change.
Yeah, that's very true. When we do our monthly investment committee meeting, I mean, one of the central things that we discuss is what do we think about inflation? What do we think about Fed policy? And directionally, what's happening with interest rates? It's a central part of what we are considering when determining how we want to invest money, how we want to allocate. And this central issue impacts not just the stock market, but also the bond market. I do feel as though the Federal Reserve has done a good job recently. I think they made a mess of things at the beginning with being too slow to react to the inflation numbers and being too passive early on. Would you agree with that?
Yeah, I would agree with that. Definitely.
So what do you expect for the remainder of 2024? As of this recording, we're in May of 2024. We'll stipulate that the Fed's policy has been a little confusing, to use your thesis. So what do you think will happen for the remainder of this year? Are you in the camp that says that we're likely to get some cuts before the end of the year?
I think they'll stay pretty consistent through the end of the year with, let's say, a 35 to 40% chance of maybe one cut coming in early fourth quarter.
Okay.
right around election time.
All right. So they would do one, which is sort of the camp that I'm in as well. And we've talked about this off air. You'd be surprised if there was more than one rate cut this year. Is that right?
Yeah, I think I would be. If they start cutting into the fourth quarter, coming into the end of 2024, I think that gives them good momentum going into 2025 to set a new plan and then really express to the public of what their thoughts on cutting for 2025 are.
So if that's your base case, if you will, that means it seems that you're not really concerned that inflation will go higher. I know depending on what you read, and I really, Brett, pride myself on reading a variety of different things, different research, different points of view. I don't want to read everything that says things are going to be great, and I don't want to read everything that says things are going to be terrible. I like the diversification of opinions I get through my, reading, research, the people I listen and pay attention to. But there are some that are increasingly talking about, hey, the Fed is off the mark and inflation is going to go up, and everybody is too relaxed about what's happening with inflation. What do you think about that thinking?
I think people are a little bit relaxed, but at the same time, where the general public and the general investor thinks about inflation, they're thinking about how it affects them on their everyday life.
Yeah.
So relaxed, yes, I'd say in the corporate federal type world, but at the
Yeah.
everyday kitchen table, I'd say most people are feeling the effects at home.
Okay, yeah, I know what you're saying, and I want to get to that because you bring up a good point. I was talking about economists, market prognosticators that think, and I've been this way too. If you listen to my podcast, and if you're present and I'm talking to clients, I'm kind of like, yeah, inflation came down and it's pretty tame and it's not too big of a problem now. I'm pretty relaxed about it also, but given what's happened over the last couple of months. I think the idea that maybe the Fed will continue to be confusing might have more merit because maybe we were, and I say we, like even me, premature in celebrating that the problem of inflation was wrestled under control. Maybe it's not quite under control yet.
Yeah, I'd agree with that, especially with a lot of the government spending going on now, some different variables that have happened since then. So that could also be an effect on it too.
And before we get to sort of the everyday American man on the street kind of view of inflation, because I want to get your thoughts on that. Uh, I said in the episode I did was that I was comfortable with higher for longer. I think it's reasonable that the Fed can take their time. They don't have to act on rate cuts with any urgency. They could wait and see how things play out. The Fed will use the term data dependent, which is sort of a useless catchphrase. But I kind of think that the higher for longer, patient Fed waiting to see how things play out is not a bad thing. I think that's reasonably good news. And even though we're not getting the rate cuts that many people expected this year, or at least not as many, that's a little disappointing. I think the market would have really liked that. But I don't think this is a bad outcome for the markets. I think it's generally sort of bullish. And I mean that in the grandest macro sense. I'm not, making recommendations here on the show, but how comfortable are you for higher for longer? Do you view that as a negative, a positive, neutral? Not sure. How would you characterize that?
I think it, as in the grand scheme of things, it's a positive thing because you have to remember too that we're in a very instant gratification society. So with the speed that interest rates were rising back in 2021 up to now, they raised them faster than they've ever done that before.
Most
So
aggressive ever.
yes, and I would say that would make expectation be that they're going to lower them at that same rate, which isn't the case. So
Yeah.
that's going to make people in general be less patient with the entire process, expecting them to come down at the rate that they went up.
It's an excellent point, and I hadn't considered that. They raised rates so aggressively, and with today's 24/7 media and instant gratification and everything's fast, 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 there's a certain amount of pressure about just bringing them down. Like we fixed inflation, so now bring it back to the way that it was, but that really can't be done. So people's expectations might be unrealistic, just not the economics, just because they want that instant gratification. So that kind of makes sense. Again, I would give the Fed pretty good marks. Since they swung into action, I give them bad marks prior to that because they waited too long. But if it does turn out that inflation stays stubborn and even ticks up, and they have to wait too long for rate cuts or even introduce the idea that there might be rate hikes as the next move, that would be bearish and that would not be well received. So hopefully, and I think they've got this right, but hopefully they are correct. Otherwise, there'll be some significant bumps in the road. Would you agree with that assessment?
Yeah, absolutely. And especially with a 24/7 news cycle, the negativity is always put in front of the viewer. So with rate hikes like that, or even with rates staying exactly where they are now, in a weird way, it's all viewed as a negative thing, which I wouldn't necessarily agree with.
Okay, well said. You touched on this earlier. I wanted to circle back to it. I talked in my episode about sort of inflation speak, that there's sort of a shorthand where I talked about, we'll say that inflation was at 9%, now it's come down to 3%, and that could be misinterpreted as a decline. And it is a decline, but it's a decline in the rate of growth. The cost of goods are still going up. They're just going up at a slower rate than they were before. And that shorthand in the media and with politicians can be manipulated, I think, to misrepresent things to clients. I feel President Biden has done that some. And I think the media does that regularly, although I get the sense the media just doesn't know because I believe they're financially ignorant. Maybe you think more highly of the media than me, but I have a feeling not.
I do not.
So you wanted to touch on a little bit about, we talk about this subject about economists, and I talk about the media and politicians and prognosticators and what we're talking about in our investment committee meeting. But this is a real issue, a real kitchen table issue for American families, this inflation problem. And it is a problem, and it hasn't gone away. It's improved. But you wanted to share, I think, some thoughts on that. So what are you thinking about?
Yeah, I mean, we see it on everyday items that we deal with all the time. I mean, anywhere from home prices all the way down to the food that we eat. So, as far as home prices, we've seen them rise so much. And we've also seen people who have refinanced back in 2021, early 2022, very low interest rates, not wanting to move, a lower inventory of housing, and the housing that's available is skyrocketing in price. So just as a example, back in 2021, a 30-year mortgage on a $500,000 house would cost you about 2.5%. Right now in 2024, that same mortgage is costing you 7.6%, give or take a little bit. Difference in monthly payment for a family on that house is a little over $1,500 a month. That's a huge amount for a normal family to pay out of their budget just in a shift of a couple years.
That is remarkable. So it's same $500,000 house, $1,500 more just because of the interest increase. And then added on to that, a $500,000 house in 2021, depending on where you are, I'm just talking in generalities, is probably $600,000 today, right? On average,
Yeah,
which
absolutely.
means that the payment would be even higher and they're getting whacked by both the higher interest rate and the lack of affordability, given that home prices have gone up a lot over the last couple of years, which
Right.
is a homeowner. Actually, I own more than one property. That's great. That has made me wealthier. But for the younger generation, it's a significant problem. And I did some episodes on this. I don't know if you've had a chance to listen about the affordability issue. It's not just that prices have gone up. Real estate over the course of time has reliably gone up. Residential real estate has reliably gone up in the US over the very long term. But what has not kept pace is the affordability, because incomes have not kept pace. So it's not as if, yeah, they're going up, but people are earning more. So they're kind of staying equal on a ratio basis. The affordability has fallen way behind when it was. I gave the example, Brett, of when I bought my first condo when I was 24. Yeah, I was 24. And I looked at the average income. I don't have the data right at my fingertips, but it was something like when I bought that condo, the average income earner and the average home in America was about a 3-to-1 ratio, and now it's well over 5. So it's good for me that I'm a homeowner, but for younger people that are looking to buy first homes, buy dream homes, buy homes to raise their families in and be part of the American dream, it's difficult compared to how it's been over the last 20 or 30 years, even longer.
Yeah, definitely. And even kind of piggybacking off of that point, the younger generation looking to get into their homes, now it requires a larger down payment, a larger liquidity, more cash to come to
Yes.
the table with. So then you start looking at the smaller things. So one thing that I picked out that I thought was very interesting, I know a lot of the listeners, as well as you, probably go to Chick-fil-A, enjoy Chick-fil-A, and
I like some Chick-fil-A.
yes, yes. So, fun fact here for you. A chicken sandwich from Chick-fil-A in 2019 would cost $3.65. Chick-fil-A sandwich now costs $6.55, an increase of 79.5%.
Holy cow. All right,
Yes.
let me just say, listener, I knew it would have gone up. He didn't share this information with me before we recorded this. I would have guessed it went up even a lot, but I would not have guessed that much. I mean, that's crazy, 79% in 5 years.
Yes. Yep. I mean, and I mean, you hear this on the news sometimes too, but even a gallon of milk in from 2021 up to now, it's increased 13.2%. So while people are getting better interest rates in the bank, CDs are better, money markets are better. When we're talking about inflation, I think that's the real inflation speak that we need to be communicating with people.
Yeah, I'm a little surprised that, given what we're talking about, that the consumer would have gotten a little more concerned about spending, but that really hasn't materialized in any big way. I think more that's probably happened is they've taken on more debt instead of slowing down spending, which has been good for the economy, but that probably isn't sustainable. Is that a good summary?
Yeah, I think so. And I might go off on a little bit of a tangent here, but I think it's relatable. Um, with the amount of credit card debt now and the amount of credit card usage, I mean, you look back 15, 20, 30 years ago at recessions before credit card usage was there. If you wanted to go buy a loaf of bread, you had to go to the store and actually have the money in your pocket. Nowadays, you just put it on the credit card. So it makes it a little bit easier for the consumer to kind of get over what that price is in a way.
That makes sense. All right, that Chick-fil-A, I keep going back to that in my head as we're talking. I'm stunned. I'm stunned. Uh one and we didn't prep this, so this is impromptu. Uh One of the things that I've heard advanced is that, okay, yes, there's more debt, but because there's a lot of money in the banking system, savings accounts, money markets, and such, and because that money is now earning more interest than it did before. When we were in a 0% interest rate environment, $100,000 in the bank was only earning like, $85 a year or something like that. And now it's getting $5,000 a year in interest. That is overwhelming the added borrowing costs and is actually a net positive. So yes, there's more debt, but there's more interest being earned on bank deposits, such that the consumer actually is in better shape than you would think if you just looked at the debt side of the equation. I kind of like that thought, but I'm not convinced, and I have not done a deep dive into it. I don't know if you've heard that before, but let's assume you haven't. What's your knee-jerk reaction to that, Brad? I'll put you on the spot.
I think that it is a net positive of having better rates and more cash in the bank, more liquidity. But at the same time, I think it's going to depend person to person, situation to situation. So a homeowner who is paying on a mortgage, for instance, in 2021, low interest rate, low payment, very little debt, is going to look a lot different than maybe someone younger who's renting, maybe paying off some student loans. That interest rate in the bank's not going to mean as much to them as it does to someone with more liquidity and, let's call it, a more stable situation.
Yeah, no, that's well said. I think you're right. You're talking about like the macro numbers, the big picture numbers, but I'm not convinced that the person that's accumulating credit card debt is the same person that has a big fat bank account that's now earning more interest. I think the person that's earning that interest is probably not accumulating debt, and they're sort of quote unquote winning. And the person that's accumulating the credit card debt is probably struggling and falling farther behind and is not quote unquote winning.
Correct.
Yeah.
Agree with you.
Okay.
Yep.
All right, cool. Well, Brett, did I do a good job hosting today's discussion?
Did a great job. I appreciate you having me.
Well, thank you very much, listeners. I hope you found value in the discussion. If there was one takeaway, it's that Chick-fil-A is way more expensive. I don't think that means you should go to Popeyes or KFC. So it probably is all of them, right? But now I'm going to go get some Chick-fil-A. Thanks for listening today. I'll be back with you on the next episode of the Simply Financial Podcast very soon. In the meanwhile, if you haven't done so already, please subscribe to the Simply Financial Podcast. Thanks again.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues, or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.